former richest man in the world, Andrew Carnegie, once said, 90% of all millionaires become so through owning real estate. More money has been made in real estate than all other industrial investments combined. The wise young man or wage earner of today invests his money in real estate. Now, this quote is over 100 years old, but still holds true today. In this video, we're going to go over the 4 ways to make money with real estate investing: long-term appreciation, principal reduction, tax benefits, and cash flow. If you stick with me to the end of this video, I'll give you some necessary tips when buying investment properties. But first, if you haven't already, please like and subscribe to this channel. Let's get started with long-term appreciation. Appreciation has to do with the home's value increasing over time. The more a home appreciates, the more profit a seller should make upon selling the home. And historically, homes appreciate between about 4 to 5% each year. According to an article on Yahoo Finance, while there have been periods of rising and falling home values, the end result is this. In the past 20 years, the average home price in the U.S. has grown from about $140,000 to about $340,000 as of April 2023. And according to the National Association of Realtors, the median price for an existing home, not new construction, was $410,200 in June 2023. That's the second highest price tag since the association started tracking the data. The all-time high occurred in June of 2022 at $413,800. With the extremely hot housing market of the last few years, home appreciation rates have been abnormally high. But the record-breaking percentage gains we've been seeing for the past couple of years in particular aren't likely to continue. As long as supply is low and demand is high, prices are going to continue to rise. Now, for a more hands-on approach, there are things you can do around the home to increase its value as well. Home improvements done in a quality and workmanlike manner can provide a real boost to your property's value. Most home improvements will seldom give you a dollar-for-dollar return, however. But what they can provide intrinsically has value as well. Let's discuss the second way to make money in real estate, and that is through principal reduction. As you make your mortgage payment every month, you start chipping away at the principal amount owed. Every month, a little more of your payment goes towards that principal amount. Also, if you decide to make a larger one-time payment, say with a nice tax return, that can also be applied directly to your principal amount, and in turn shortening the length of your mortgage and reducing your overall interest paid. The difference between what you owe and what your home is worth, that's your equity. The more your home appreciates and the more payments you make should increase the amount of equity you have in your home. The third way to make money in real estate is through tax benefits. Let me first start off by saying I'm not a CPA and I'm not giving tax advice here, but there are many tax advantages to owning real estate. You get to deduct expenses directly tied to the operation, management, and maintenance of the property on things like property taxes, homeowners insurance, mortgage interest if you have a mortgage, legal fees, think evictions, management fees, and the cost to improve and maintain the property. There's also what they call depreciation. You're allowed to take the depreciation deduction for the entire expected life of the property, currently set by the IRS at 27.5 years for residential properties. For example, say you purchase a home and you intend to rent it out. The home is only worth $100,000, excluding the land it sits on because land is considered to have an indefinite useful life. You divide that $100,000 by the 27.5 year expected life of the dwelling, you can deduct $3,636 in depreciation each year for as long as you own the property or for the 27.5 years. Now, the fourth way to make money in real estate is through cash flow. This is probably my favorite reason for owning investment properties. Cash flow can be positive or negative. Positive cash flow means a property has more money moving into it than out of it. Negative cash flow means that a property has more money moving out of it than into it. Since we're discussing real estate cash flows, we're talking about the money that's generated by the property through rental income and money that's spent in association with the property. Positive cash flow is preferable because it means you're making money on the property. The bigger the profit margin, the better the return on investment. Positive cash flow can also make real estate investments easier to maintain, since you may have a surplus of cash you can use for your expenses. As promised earlier, now it's time for some necessary tips if you're considering investment properties. Number 1, mortgages. Guys, if you need to get a mortgage to buy a rental property, get a fixed rate loan at either 15 or 30 years. Unlike a variable rate loan, in which the interest is only fixed for a certain period of time, a fixed rate loan is guaranteed rate for the life of the loan. Therefore, you will know what your payment will be on the property, and that it will remain constant for the time that you own it. If rates drop, you can always refinance it later if it makes good financial sense to do so. Number 2, buy smart. If you haven't heard it before, hear it now. The money you make on the home happens when you buy it. If you can't get a good deal on the home, don't buy it. Leave the emotion out of it. Plain and simple. I've seen it happen so many times where investors buy a home banking on long-term appreciation and in turn overpaying for the home. Then, to make matters worse, they rent it at or below market rates. Then when the market softens, you may end up owing more than the home is worth. Plus, you're not getting the appropriate amount of rent. It's a bad deal. Number 3, cash flow, cash flow, cash flow. As I said earlier, my favorite part of real estate investing is the cash flow it produces. What is it going to cost you and how much are you going to make? Real estate investing can be an absolute nightmare if you're operating on thin to no margins and something major happens to a home like needing a new AC unit or a roof, and you just lost a year's worth of profits with one event. Cash flow should be your primary factor in deciding whether to buy a piece of investment property. Number 4, run it like a business. The first couple of years we owned property, I was the property manager. I wanted the experience, and while I learned from it, it wasn't for me. I was too nice and too lenient with the tenants. I bent over backwards to please them. I spent more time trying to make the tenant happy than running it like a business. I ended up turning over our investment properties to a full-time and well-respected property management company for a less hands-on approach. I do communicate with them regularly, and they always confer with me about rent prices and repairs and any important issues that arise. Number 5, know your area. Don't get so caught up in the headlines that you never make the investment. Every city has its own nuances that make it stand apart from others. While homes on the West Coast might cash flow terribly, they might appreciate tremendously. Homes in the Midwest might not appreciate as much, but the cash flow is great. My point is to know your market and align yourself with people who know it too. Whether that is other investors, mentors, real estate agents, surrounding yourself with knowledgeable people will better your chances of success. Guys, I really hoped you enjoyed this video and you got something out of it. Let me invite you to watch another video that shows how I bought a $50,000 rental house and some more in-depth discussions on rental property. I'll link that video here. If you have any questions about real estate investing, feel free to comment below. Please like and subscribe to this channel, and as always, thanks for watching.